Just a normal September in our book.
September basically is a very volatile month. It's living up to its billing this year.
You've got strikes, you've got a potential shutdown, you've got a student loan resumption.
You have oil prices are up 32% from the June lows. You have the unknowns of the Fed. You have the 10-year yields are inching higher.
Look for when bad news becomes bad news and be ready to attack that kind of weakness. We're getting closer to that point.
More of this kind of stock picking going forward.
Stocks follow profits, and I think that we've seen a trough in profits.
Whether it's a soft landing, a no landing, a hard landing, whatever kind of landing you want, there's always a catalyst that takes you out the other side of it. And it's an improved outlook for money. That improved outlook for money always comes from lower treasury rates, lower mortgage rates, and lower corporate rates. And right now, as you know, we're making a cycle high for all of them. So the idea that people like me are going to come on here and say, now run for the hills because the market's starting to weaken, it's already been extraordinarily weak. So what I think you want to do is look for when bad news becomes bad news and be ready to attack that kind of weakness. And we're getting closer to that point. If you talk to somebody that has student debt, they haven't had to start paying it yet. But if you ask them if they've adjusted their budget on the fear of paying it, they have. And their credit card rates are, all those things are there. But that's why the average stock's down 29% from its 52-week high. Almost 55%, according to my friends at Ned Davis, of NYSE stocks are down more than 20%. So some of that is going to be discounted. There's really three phrases of this game as you talk about economic weakness. There's when good news is bad news because it means a tighter Fed. We got that in 2022. Then you get good news, or bad news is good news because it means the Fed's going to stop. We were in that into the summer of this year where the market had rallied over 20% off the low. You ultimately got to get into that bad news is bad news. And that's when you want to look to take advantage of the opportunity. That's when you want to get prepared to attack the market, not to actually just jump right in. The Fed is going by very inaccurate data. When we look back, we're going to say, oh, yeah, rates went up to over 5%. Consumer credit was weakening. And corporate rates and mortgage rates stayed high. Yeah, that's why things got hit. So I think, again, Courtney, the really most important point is it's already hit so many stocks. The Russell 2000 has been smoked. Now's not the time to start getting nervous. I think now is the time as bad news becomes bad news and gets priced in that you want to look to be more aggressive in those areas that are early cycle stocks. It's just a little bit too early yet.
I would have thought with 500 basis points or 525 basis points of interest rate increases, we would have slammed the brakes on consumer spending, and it has not slammed the brakes on consumer spending. It continues to exceed expectations.
September basically is a very volatile month. It's living up to its billing this year, right? We're down about 6% from the highs. The VIX is up 34% in 2 weeks' time. And you just cited, there's a multiple of issues, right? You have the unknowns of the Fed. You have the labor strikes. You have oil prices are up 32% from the June lows. You have the government shutdown, which is a big looming situation. I think it'll be short-lived, but it's another uncertainty. And of course, I think the biggest thing is you have the 10-year yields are inching higher at 4.6%. You're at new cycle highs. And so as rates go higher, that's competition for stocks. So I'm not surprised we've seen this kind of choppiness and this trade down. I think better things are ahead for us, though, because I think the economy is hanging in there much better than most people expected. Stocks follow profits, and I think that we've seen a trough in profits, and I think you're going to see companies that are going to be able to handle the higher prices, but also they're going to be able to price increase as well as cut costs, and the demand side of the equation is better than expected.
Just a normal September in our book. If you go back to 1950, when you have a return in the markets of over 15% through August, you typically have a very strong end of the year around 4%. I think 4% is the magic number. The 4% is the average fourth quarter return since 1950. 4% is the average return when you see a negative September. As I go around and talk to clients, Mike, institutional clients are underperforming. Long only missed the January, February initial move in the markets. Hedge funds are dramatically underperforming because they've been so negative most of the year. And obviously, they love this action in September. So I think earnings have come in and they've been pretty solid. And I think third quarter earnings are going to be pretty good as well. So I think we have a pretty decent chance at a liftoff. And history shows that it's pretty normal to have a liftoff, especially considering how strong the first 8 months of the year were. On oil, it's demand outstripping supply. for the first time in a long time. And I think coming off of what we had a very strong summer in terms of people traveling, and it's really a supply issue right now trying to match up with demand. Now, we'll see what happens a year from now. When you kind of look out and plan how, when you're building, building out on the corporate side, I think that energy cost is going to be going down next year. That's number one. In terms of the economy, look at how some of these consumer stocks have done, actually held in there quite nicely. And I think heading into the holiday shopping season is going to be really the online side's going to do really well, high end's going to do really well, and kind of the lower end, kind of the consumer staple-ish type consumer stocks, and that would include Costco and Walmart. The consumer staple-ish type tech, meaning Apple, Microsoft, Google, Netflix. We've had really healthy kind of pullbacks and opportunity to, I think, add to positions. In terms of the high multiple names, even some of the forward multiples on NVIDIA and like are looking more attractive.